In 2007, Wall Street took $1 trillion of risky debt, hid it inside boxes they called CDOs, and stamped them safe. Then it all blew up. In 2026, big tech is running almost the exact same play to pay for artificial intelligence. $1.6 trillion of debt, most of it hidden off the books. This isn't a prediction, it's a pattern. Let me show you the trick. First, a number. This year, 5 companies, Microsoft, Amazon, Google, Meta, and Oracle, will spend around $750 billion building AI. Data centers the size of small cities, millions of chips, entire power plants just to keep them running. And that's only the start. One project alone, called Stargate, is a $500 billion bet by itself. It is the biggest building boom in corporate history. So the first question is simple. Could it actually work? To be fair, the believers have a real case. This is not the dot-com bubble, where companies with no revenue burned cash and vanished. The demand here is real. Amazon's cloud is growing 24% a year. Google's almost 50. Google alone is sitting on over $460 billion in signed orders. It hasn't even filled yet. Microsoft says it simply can't build fast enough. So maybe AI really is that big. Maybe it does pay for everything. But here's the problem. Even if every dollar of that demand is real, the spending is now growing about 3 times faster than the cash coming in. And when you spend faster than you earn, you have one option left. You borrow. But before the borrowing, there's a stranger thing happening. A lot of this money moves in a circle. Nvidia, the chip maker, agreed to put up to $100 billion into OpenAI. OpenAI turned around and promised $300 billion to Oracle and billions more to a cloud company called CoreWeave. And Nvidia? It owns a piece of CoreWeave too. Chips, cash, and cloud credits, rotating between the same handful of companies. Every loop looks like booming demand. Critics have a colder word for it, circular, the same dollar waving at you as it passes by 3 separate times. It isn't necessarily fraud, but it makes the boom look a lot bigger than the cash underneath it. So how are they paying? For years, big tech had an unspoken deal with investors. We fund our big dreams with our own cash. Money we actually make. That deal just quietly died. In the first half of this year alone, these companies borrowed nearly $200 billion in bonds, and their free cash flow, the money left over after the spending, is collapsing towards zero. Oracle's already there. This year it spent almost twice what its own operations brought in, and its free cash flow fell to negative $24 billion. Analysts expect the whole group to burn through its cash cushion within months. The richest companies on earth going cash flow negative on purpose. But the debt you can see isn't the scary part. It's the debt you can't. Here's the trick. Last year, Meta needed tens of billions for a data center in Louisiana. It did not put that debt on its own books. That would scare investors. Instead, it built a separate little company, a shell. Meta owns 20%. A Wall Street firm, Blue Owl, owns the other 80%. The data center goes in the shell. The debt goes in the shell. And on Meta's books, that debt isn't debt anymore. It's rent. Then Meta did it again in Texas with BlackRock. $12.5 billion of debt moved off the books into a box next door. Google has quietly guaranteed $44 billion of leases on data centers it doesn't even own. Add it all up, and across big tech, roughly $1.6 trillion of debt now sits in boxes exactly like these. And there's a second trick, hiding in plain sight. These companies are betting everything on chips. But a cutting-edge AI chip is old news in about 2 or 3 years. A faster one comes out every 18 months. So here's the question. If the chip is really useful for 3 years, why do these companies spread its cost across 6? Because it makes today's profit look bigger. Stretch the cost out, and this year's earnings shine. Critics estimate this one accounting choice has overstated big tech's profits by around $176 billion. That is not a rounding error. That is a write-down waiting for a bad quarter to arrive. So who is actually holding the risk? Not the tech giants that kept it off their books. It's the lenders, the private credit funds like Blue Owl and PIMCO, the banks. And behind them, the pension funds and insurance companies that quietly bought the debt, which means it could be your retirement 3 steps removed. If the AI bet pays off, everyone gets paid, and all of this looks brilliant. But if the revenue is late, it takes 5 years instead of 2, the debt does not wait. The interest is due now, and the people on the hook are not the ones who made the bet. If this structure sounds familiar, it should. A special box, off the balance sheet, holding risks that nobody wants to count, and blessed by Wall Street. That is, almost line for line, how the banks hid the subprime mortgages before 2008. Back then, the collateral was houses that couldn't pay. This time, it's a bet that AI earns enough, fast enough, to cover more than $1 trillion of debt. The bet might win. Honestly, it might. But the debt doesn't care. It's real, whether it's on the books or in a box. We don't give financial advice, and nobody knows the timing. But when the smartest people in the room start hiding how much they owe, and everyone agrees not to look, you've seen this movie. You know how it ends? The only question is when.